I'd like to come back to a comment we picked up on just now, and that was really if I have major life transitions in my life and what have you, that might require that I have a lot more insurance than I currently have.
Yes.
Now we've got the question of insurability and the potential that as I get older, I'm more likelihood have got a higher risk of not getting that life cover. How's the market or the industry more specifically responded to that call?
I think from that perspective, there are benefits that you can actually purchase now when you're young and healthy that you can actually exercise later on. And those are built into product design and product benefits. There are also options around underwriting where they, in some instances, underwrite you upfront in terms of components that you may exercise later on. So you can take out benefits that you actually exercise later on when the need becomes apparent. A very simple example is a young individual who may require, let's just use for argument's sake, income disability as an option, and later requires life cover when he gets married or she gets married. That could be an alternative which you can exercise on exactly the same product, but you have the option of exercising it later. So you have products and benefits that are designed to handle that situation.
Okay, so what we're saying is basically it's something that I can buy at sort of a discounted rate now until I exercise that option at a potential future date. And I'm presuming there's certain things that have to happen in my life for me to be able to exercise them?
Yes, you can. So life-changing events, as Rayland referred to, are the huge opportunities you can use to exercise it. So the birth of a child, getting married, getting divorced, unfortunately, or perhaps getting promoted. So all of those instances would qualify because there would be a review of your need. And let's also say, for example, there's a partnership or a business venture. There are opportunities in all of those around exercising those options.
Okay. Rayland, let's touch quickly from the point of view of saying, well, if I do need to replace my policy, what are the things that I should be potentially looking at, and what role does the advisor need to play within that?
Replacing policies can be quite a dicey situation. Unfortunately, a lot of advisors out there have really taken carte blanche in the situation and actually just gone to replace policies to make more commission. Now, how it actually works is if, for example, you're looking at an old generation product versus a new generation product, there's a cash value that's available on an old generation product, for example. Very often, though, people are under the impression that they're going to have the life cover amount as well as that cash value paid out. Now, if it's a situation where health has changed or the circumstances have changed for an individual, it might not always be the right advice to actually stop one of those policies, even if it could be a bit cheaper to start a new generation product. So it's got to be taken into consideration on each individual case, what their specific premiums are, what their health situations are, their insurability, and from a financial advice perspective, we really shop around, and from a phase as well, from a phase perspective, we really shop around and make sure that we're giving you full advice in terms of all insurance companies to make sure that what you're getting is actually what you need. Another thing to be aware of in terms of replacements is don't allow the policy to be cancelled before the new policy has already been accepted by the new insurance company. Unfortunately, in some situations, you find that an insurance person will actually go and cancel somebody's life cover in anticipation of a new policy issuing. Suddenly there's a new medical issue that has arisen, and suddenly that person becomes uninsurable. And that really starts to create an issue because then they cannot get the old policy back and they're now sitting without cover. So as long as it's done correctly with the right advice, it's something that needs to be looked at in each person's situation.
Great. I'd like to, before we close off, just pick up on one issue, and I think it's quite a burning one, and that of HIV and AIDS. How does it fit into the scope of life policy? Either I'm living with HIV and I want life cover, or I've got life cover and now only am living with HIV. What are those two scenarios and how do they play out?
Well, if you contract HIV after your policy has become in force, then you are covered. There are absolutely no factors that can change it. That's why we take out insurance for the future when things change, whether it's your HIV status or your health or whatever else. So then once you're covered, you're covered. The days of us imposing HIV exclusions on policies and not paying out in the case of HIV, that's long gone. At underwriting stage, if somebody is HIV positive, there are now insurance products available. Previously, HIV was uninsurable. That has changed.
Right.
It is now an insurable and a treatable and a manageable disease. So the premium will still be higher because of the higher risk, but at least our policies available now.
Okay, so we do have the option of having life cover even if a person is HIV positive, and if they're not on inception, we understand the risks up front and there should be no problem. Right. Marita, Neelan, Raylan, thank you very much for your time this evening.